Let's talk now about stock dividends. With a cash dividend, we give cash to our stockholders, right? With a stock dividend, we don't give cash to them, but instead we give them more shares of stock based upon how many shares they already own. Now, to issue a stock dividend, we cannot go over the maximum number of shares that we can issue per the charter. Remember, the charter has a maximum number, so we cannot exceed that when we do a stock dividend. Stock dividends, like cash dividends, must be declared by our board of directors. Why issue a stock dividend? It makes investors happy. All right. Now, we're going to see there's some kind of, I think, a little bit tricky things to a stock dividend, but stockholders get more shares of stock. It makes them happy. We're going to see in a minute that they shouldn't really be happy. There's no reason for them to be happy, but they are, and it doesn't cost us anything. So if you make people happy and it doesn't cost you anything, sounds like a pretty good idea for a business, doesn't it? We're going to see that a stock dividend causes the market price of my stock to go down. There are more shares outstanding. The company is worth the same as it was to begin with, so the value of each share goes down. If you've had economics, you know about supply and demand. What tends to happen when the price of a commodity goes down? Demand tends to go up, and as demand goes up, that can make your price then go back up also. Provide stockholders with a non-taxable distribution. If we give them a cash dividend, they have to pay tax on that. They do not pay tax on a stock dividend. To capitalize retained earnings. We'll kind of come back to that. That's a little sneaky thing also with stock dividends. When we issue a stock dividend, now understand, let's say there were 1,000 shares of stock outstanding already. If I do a 10% stock dividend, that means I'm going to issue 1,000 times 10% is 100 new shares. The number of shares outstanding is going to go up. Is the company worth any more or any less after the stock dividend? No, they're still worth the same, but now their ownership is divided amongst a larger number of shares of stock. The market price of each share then is going to go down. Let's do an example. We have 100 shares outstanding and it's trading for $55 a share. 100 shares outstanding, $55 a share. How much does the public think that my company is worth right now? If ownership in my company is represented by 100 shares trading for $55 a share, 5,500 must be what the public thinks my company is worth. We just multiply it. I'm going to do a 10% stock dividend. How many new shares are we going to issue? Well, how many did we have before? 100. 10% of that says I'm now going to have 10 new shares. How many shares are outstanding in total now? 110. We had 100. 10 more. There are now 110 shares outstanding. Well, has the net worth of my company changed? Am I worth any more or any less? No. I am still worth 5,500, right? But now ownership of my company is divided among how many shares? 110. So each share of my stock right now would, instead of trading for 55, now be trading for 50. Are my stockholders any better off after a stock dividend than they were before a stock dividend? No. They have more shares of stock, but each share is worth less. More shares of stock, each one is worth less. They're in exactly the same position after the stock dividend as they were before. However, investors often don't realize that. They have more shares of stock, oh good, that's great. They don't realize they really are no better off. Now, can they end up being better off? Well, yes, because first off, what's happened to the market price of my stock? It's gone down. We didn't make it go down by much in this case. The bigger the stock dividend, the more you're going to see the market price fall. What happens though if that drop in market price triggers an increase in demand? An increase in demand then could drive my price back up. Can my stockholders make money off this deal? Well, yes, but only if the stock price goes back up. If the stock price stays at 50, they're no better off after it than they were before. But they don't usually understand that. So they're happy. They got more shares of stock. They really are no better off then. So how much does the public think my company is worth now? Well, 110 shares of stock, trading for $50 a share. My company is still worth $5,500. So issuing a stock dividend does not make my company worth more or worth less. Stockholders are no better off after the stock dividend than they were before. The impact of a stock dividend is that my total stockholders' equity does not change. We're not going to impact my assets, my liabilities, or total stockholders' equity, but we are going to kind of shuffle around some items within stockholders' equity. We're going to see that my paid-in capital is going to go up, my retained earnings is going to go down. And we'll see that whenever we actually make some journal entries in just a minute. To journalize a stock dividend requires a new account, and it's our tongue twister. It is called Stock Dividends Distributable. Distributable means to be distributed. To be distributed. It is not a liability. Now, whenever I declared a cash dividend but haven't paid it yet, it was a liability because I had a legal obligation to pay it. When I declare a stock dividend, it's not a liability because I don't pay it. Remember, I'm not paying anything for this stock dividend. We're going to talk about small stock dividends, not large ones. Let me just show you the journal entry. My debit goes to an account called Stock Dividends Declared. Now, we had a similar account last class. What account do we debit when we declared a cash dividend? Cash dividends declared. Do you see the similarities? I want you to notice that similarity between both. My credit. Now, I'm going to issue new shares of stock. You might think I would credit common stock, but remember, the day that I declare it, I don't actually issue it on that day. Remember, there are those 3 days, there's that built-in lag when I got to make the list to see who wants my stock. I'm going to declare it today, date of record later on. After that, I'm actually going to issue the stock. So I can't credit common stock account yet because I haven't issued it. I'm going to issue it X number of days in the future. So my credit goes to a temporary stockholders equity account called Stock Dividends Distributable. In other words, stock dividends that I am soon going to distribute. My credit to that account is going to be for the number of shares times the par value. Number of shares times the par value. And we're going to see in a minute, the reason that is we're going to take the amount later on out of that account and put it into my stock account. So that's going to be at the par. Hopefully the stock is worth more. On that day, I'm going to credit the extra to paid in capital in excess of par. Now let me go back to the debit. My debit to stock dividends declared is going to be for the number of shares times the market price on the date I declare it. Debit stock dividends declared, number of shares times the market price on the date that I declare it. Credit stock dividends distributable for the number of shares times the par value or stated value if that were the case. Again, temporary stockholders equity account, I'm going to transfer that amount into common stock when I actually issue it. The extra amount, assuming the market value is greater than the par value, the extra amount goes to PIC in excess of par. Stock dividends declared, you think of it like cash dividends declared. So we're going to close that out to retained earnings. Date of record, make a list, check it twice. Whoever owns the stock on that day is going to get the dividend. On the date that we issue the stock dividend, we need to make that stock dividends distributable account go down to take it off my books. The amount in that account, which is the number of shares times the par, is a credit to common stock. Because remember, when I declared the dividend, I credited stock dividends distributable for the par value. Why? So I could then here, when I issue the stock, take it out of that account, put the par value into the common stock account. We don't need our calculator to make that last entry. We are going to move an amount out of stock dividends distributable into common stock for whatever I credited that account for in the original entry. You already know the amount from the original entry. It's simply going to be the par or stated value. Let's do an example. 1,000 shares, $10 par value common stock is outstanding. Declare a 15% stock dividend. Market value is $16 a share on the date that we declare it, $18 on the date that we issue it. Right now, I want you to draw a line through that $18 on the date we issue it and write, I don't need this. You don't need the 18. You do need the 16. You do not need the market price on the date that you issue the stock. That's a trick, but it's not a trick. If I tell you in advance, I'm going to do it. So I don't need that $18. Just completely ignore that. I do need that $16 a share. The first thing we need to figure is how many new shares of stock is he going to issue. How many shares were already outstanding? 1,000. And we're doing a 15% stock dividend. 1,000 times 15 says I'm going to issue 150 new shares. Now that is a really important number, folks. I put a star by it. If you miss this number, everything is wrong from here out. So it's a critically important number to know how many new shares we're going to issue. It's the number of old shares times the percent of the stock dividend. The journal entry to record declaring the stock dividend is the debit to what account? Not cash dividends declared, stock dividends declared. So I want you to write down a debit to stock dividends declared, and then we have to think about the amount. The amount is going to be the number of new shares times the market price on the date that I declare it. So I'm going to debit stock dividends declared for 150 new shares times $16 a share. My first credit is going to go to stock dividends distributable, stock dividends distributable for the number of new shares times the par value. Well, 150 new shares, the par value is how much per share? $10 per share. 150 times 10 says I'm going to credit stock dividends distributable then for $1,500. Why could I not credit common stock right now instead? I haven't issued it yet. Exactly. If I could declare it and issue it on the same day, that'd be really nice, and I could credit common stock, but I can't. Got to be a built-in time delay. So credit stock dividends distributable for the number of shares times the par or stated value. To make it balance now, it's just as if I had issued the stock. My extra credit goes to PIC in excess of par, for whatever it takes to make it balance. Now, if year end were to approach right now and I've declared the stock dividend and I have not yet issued it, and that stock dividends distributable has a balance right now on my books of $1,500, I'm going to list that in my stockholders' equity section. I'm going to list it right along with my common stock and my preferred stock. I would then show stock dividends distributable. It's a temporary stockholders' equity account. Whenever I issue the stock, this part's pretty easy. I have an account I need to wipe off my books. What is it? The distributable. Debit it. Why? To make it go down, my credit goes where? Common stock. Plain old common stock. Anytime I issue stock, I'm going to credit common stock. My credit to common stock has always got to be for the number of shares times the par value. That's why in the original entry to declare the dividend, I had to credit stock dividends distributable, again, for the number of shares times the par. We don't need that $18 market price on the date we issue the stock. Completely disregard that. Has nothing to do with how we're going to record. Closing interest. What account do we need to close out? Now, we can think back to our cash dividends that we did last class. REID, fourth closing entry, closed out dividends. What did it look like last class? What account did we debit for a cash dividend? Retained earnings, good. To make it go down, very good. Last class, my credit went where? Cash dividends declared. Now my credit goes to stock dividends declared for whatever is in that account. How much do we have in stock dividends declared? $2,400 was in stock dividends declared. Not in the distributable, but in stock dividends declared. So do you see how the closing entry is really the same, be it cash dividends or stock dividends? Let's see the net effect of all these entries. What is the ending balance in stock dividends distributable from all those entries we made? Zero, right? We credited it, we debited it, it's down to zero. Do you see where it has no balance right now? Stock dividends declared. What is your ending balance in that account? Zero. Common stock. What is the overall effect that these entries have had on my common stock account? They made it go up, good, by $1,500. Credited common stock for $1,500, made it go up. And how about my PSC in excess of par? What is the overall effect on that account? It also went up by $900. Finally, what is the overall effect on retained earnings? It went down by $2,400. Common stock went up, PIC in excess of par went up, retained earnings went down. What is the overall effect on my stockholders' equity? Bottom line, zero. Two accounts went up, one by $1,500, one by $900. One went down by $2,400, zero's out. Total stockholders' equity has not changed. Common stock has increased, PIC in excess of par has increased, retained earnings has gone down. When I talked about stock dividends a minute ago, I said one feature of this is that it capitalizes retained earnings. To pay a cash dividend, you have to have two things. What are they? Cash and retained earnings. Now, what if I did this stock dividend? What impact does that have on retained earnings? Makes it go down. Didn't cost me anything. Remember, all I did was I handed out new pieces of paper, basically ownership in my company, right? Didn't cost me a penny. Does this increase or decrease the amount of retained earnings that are available to my stockholders in the future to receive a cash dividend? It decreases it. That is now a reduced amount that is available to pay a dividend, a cash dividend then, because my retained earnings has gone down. So stockholders are no better off before this than they were after this. They have more shares of stock, but each share is worth less. They're in no better position after than before. Can they end up being in a better position? Well, yeah, if the stock price goes back up. But that is really the only way that they're going to come out ahead on this transaction. Unfortunately, or perhaps from the company's standpoint, fortunately, stockholders don't realize that. When they get new shares of stock, they're happy. They think they got something good. They don't realize that really they haven't.